Hello, my name is Bret Gum, a licensed crop insurance agent with AgRisk Advisors. In our work as trusted advisors in crop insurance, we know that the risk management decisions you make for your farm have become increasingly difficult. With less than ideal prices and increasing inputs, it can be hard to know when to increase your safety net or save your money and put it somewhere else in your operation. Thankfully, the U.S. is interested in keeping family farms and ranches on the land for our food security. Federally subsidized crop insurance is a core tenet of that effort. In fact, crop insurance is unique. It is different from your typical insurance, which protects physical assets such as building or machinery. Rather, crop insurance protects your annual production and revenue. This allows us to help you utilize the coverage in a way that most effectively manages the overall risk of the farm and allows you to be more assertive in the many other decisions you face daily. Bottom line, it gives you more flexibility in maximizing your cash flow. In this video series, we'll break down the basics of crop insurance to help you utilize crop insurance in a way that best manages the risk in your operation. We'll be covering some of the most common types of crop insurances and how they differ. Additionally, we will be going over how to maximize the benefits of crop insurance by properly utilizing your guaranteed revenue. So let's get started. There are many types of crop insurance policies and policy options. These policies have improved over time, making the final coverage decision more complex. Having an AgRisk advisor on your team makes those decisions easier. In this video, we will be going over two of the most common types of policies. The first is called yield protection, otherwise known as YP. As the name suggests, this protects you against yield loss. This is done by taking the average of your crop yields and ensuring a percentage of that average. The crops and yields that you have produced in the past are known as your actual production history database or APH database. You must always have between 4 and 10 years in your database. If you do not have any yield history in the county, you get 4 county T yields. The county T yield is a yield that is based on the growing conditions in your county and will vary from county to county. As you create your own yield history, it slowly replaces the county T yields. Now, even though YP is only protecting you against yield loss, a value must be assigned to each bushel. As you know, prices are constantly changing based on the market. To keep the price relevant to the market, there is a discovery period to determine the price each year. By taking the average of the daily close on the Board of Trade for approximately 30 days, a projected price is established. The price of corn, for example, is discovered during the month of February. If you have a loss that year, then you will be paid the February price for each bushel lost. The second type of policy is called revenue protection, otherwise known as RP. Revenue protection still protects you against yield loss, but also protects you against price loss. Think of RP as yield protection with a put option added into the policy. Just like YP, a price is discovered before the growing season, but there's also what is known as a harvest price that is discovered during the typical harvest season. This is meant to protect you if the price goes down during the time you would normally be selling your crop. When the price goes down from the projected price, the bushels you produce are calculated at the lower price, meaning it will be harder to reach your guarantee, resulting in a higher chance of an indemnity payment. On the other hand, if the price goes up, it is still protecting your operation from price fluctuations. When the price goes up and you have a bushel loss, those bushels will be calculated at the higher harvest price, resulting in a higher indemnity payment. Now that you understand the basics of these policies, it's important to know how they can be applied. Specifically, whether they will be applied on a section-by-section basis or on a county basis. When you insure fields on a section basis, that is known as an optional unit. This means that each section will stand on its own regardless of how another section does. If you have a loss on one section, it will not impact the loss on another section. For example, if a hailstorm comes through and takes out a field of corn in one section, but a field in a different section does fine, then the hailed field will have a loss resulting in a payable claim, even though the other corn still produced above its guarantee. If you wish to insure on a county basis, that is known as an enterprise unit. This means that all the acres of a crop in one county are all put together for loss purposes. When using enterprise units, all of your planted acres in the county have to average below your guarantee for you to have a loss. This means that you are less likely to have a loss resulting in a payable claim each year, but this is offset by the fact that the coverage is less expensive than optional unit coverage. Because of the lower rate, you can actually purchase a higher coverage level for enterprise units for the same cost as you would pay for optional units. If you have fields that typically have similar production, then enterprise units might be a good option. If you have sporadic production from field to field, then optional units might be the better option for you. If you would like to compare how an optional unit versus an enterprise unit policy would have performed in past years with your crops and your yields, we can do that for you. This can give you a better idea of what policy is best for you in the future. I'm Bret Gum, your AgRisk Advisor, with you no matter the weather.